Well, howdy, y'all. Welcome back to another dividend hour. We're going to call this the Wealth Circuit Investing Hour. This is strategic dialogue for discerning investors. So we are putting our thinking caps on here. This is my thinking cap. Hopefully you have a thinking cap at home. And we're going to just talk about stocks tonight. There's one stock that I have added to the portfolio today. So I'm going to share that with you. It is probably a bit controversial, but hey, that's what we're about. If this were easy, anybody could do it, right? So I'm glad to be back with you guys tonight. I tell you what, two things I want to point out. First of all, it is June the 3rd. Can you believe that? The year is almost half over. I can't get over that. Time seems to go so much faster now. The second thing I want to point out is that last week, after the live broadcast last week, I went and helped a guy move some beehives, which was quite an ordeal. They were very mad. And so anyway, it was a long day. But after that, man, I got really sick. So I've been sick for like 4 or 5 days. So anyway, I'm back on the mend and did some work on the farm today. So I feel pretty good, and I'm so glad you're here tonight. So let's go ahead and get this thing kicked off. Let's see who all's in the place. We only have 10 viewers at the moment, so this shouldn't take long, but we got Pat is in the house. Good evening, my friend Pat. We got Jim Betts, who just celebrated a birthday recently. And so happy belated birthday, my friend. We've got Slammer 6789. He's ready for class. There you go. And that's all I see at the moment, unless there's John Jay is in the house. Hey, John Jay, what's going on, my friend? Then we have Mike Chelednik. So good to see you, Mike. I think I've seen you on here before, so it's good to see you, my friend. And if you're not on the Discord group, feel free to click that link in the comments below. It's free to join. Love to have you in there. We love talking about stocks and all kinds of good things when it comes to investing. One thing I've been learning over the past week or so is that when you take our kind of group here on YouTube, there's a lot of folks that have a lot of good investing experience. But when I try to broaden that out, like to my friends and family, it's pretty sparse in terms of understanding investments and things like that. So that's what we're about, is trying to help people understand that. I know sometimes we kind of go a little, on the more technical end of things, but, I do try to keep it where, if you're kind of new to the investing world, that you can kind of keep up with that as well. But either way, if you listen to it a couple of times, it might work out for you. So we got KSM 300. If you remember this old video comment, the last time those bees were that mad was after the Intel dividend cut. Absolutely, my friend. I tell you what, they were mad about that dividend cut. Just a little bit about that as we kind of get some of our viewers here. There were 10 hives. We moved 8 of them last Tuesday. The guy who actually bought them and was moving them to his place, he had gone and sealed them up, right? And so he sealed the front up so they couldn't get out. Well, lo and behold, there were holes in 2 of the hives. So they were not locked in. And when we started moving those hives, they let us know very quickly that they were not happy with us. And so that was 25% of the hives weren't closed up because they had an escape hatch. So it was quite an ordeal. But hey, we did it. Hey, we've got Honeybee in the house. Good to see you, Honeybee. Howdy. It's good to see you. I do have some honey bee hives. So, I love that name. So welcome to the program. Let's see what else we got here. Jacob Harrison is in the house. I haven't seen you in a while, my friend. I'm glad you're back as well. We got two Kevins. Kevin Mendoza is here. So I think, as I'm apt to say that we have a quorum of Kevins, so we can get started. Let's see if there's anything else. Let's see. Okay, yeah. Got Russ, my buddy Russ Knopf from Dapper Dividends is in the house. He says, I'm looking like Indiana Burgess over here. Yeah, exactly. I got this hat in Wyoming on our vacation, and I thought I'm just going to start wearing it because I didn't buy it to sit it on a table. It is going to be worn. So I'm going to wear this hat. And if you like it, that's great. If you don't like it, hey, that's great too. Everybody has their own opinion. And so, hey, it works. Oh, man, we got another Kevin now. Kevin D. Williams. Man, if we can get the other Kevin, we would have 4. But right now we have 3. And so that's great. Yeah, Jim Betts says Indiana or crocodile. That's good. So, hey, that's really cool. But you probably are really wondering, now that we're 6 minutes in, what stock I bought today. So I'm just going to go ahead and jump right in. And I want to hear your comments on it. But I'm also wanting to know what you guys are buying. And I'll talk a little bit more of some other things that I bought, which I already own. I just added to some positions. But for now, let's talk about what I bought. I'm going to go ahead and take Jim's comment off of here. So yeah, you see me sporting this new hat. At the time I had sunglasses on, but I don't wear sunglasses at night. So there you go. My new stock is called Lamb Weston. And I say this is a bit controversial because I want to walk through this due diligence process with you, because this is not a slam dunk. And I think there's some value here, but sometimes value's in the eye of the beholder. So when we do due diligence on companies, we want to be looking at both the things that are going to make this company succeed, and those things that are risks, and those things that are going to be in the way of their success. And I want to talk through a little bit of both of those tonight with you guys. So I have a few slides here. I'm not going to go through like each bullet point, but I will talk about some of the things that came out in my due diligence. And I will tell you, I was on the fence. I was leaning yes, I was leaning no. I finally ended up with a yes. And I started with, well, I'm not going to tell you what I started with. Let's go through the due diligence. So we've got Lamb Weston. Now, if you're not familiar with Lamb Weston is a French fry company, and they basically make French fries for restaurants, and they also have a retail thing, like in grocery stores. But that's not their main thing. Their main thing is about quick service restaurants like McDonald's, Burger King, Wendy's. So a lot of the fries that you see with those large chains comes from Lamb Weston. They are the #1 French fry producer. I'll just go ahead and show you. The #1, they call it frozen potatoes, so I will call it frozen potatoes. They call it, they are the #1 frozen potato company in North America, #2 in the world. They are #2 to McLean, who is the #1 in the global frozen potato realm. This freaked me out. Can you think about this? There are 80 million portions of fries sold every day worldwide. 80 million boxes of fries. That is an incredible amount of fries to me. I don't know why that seems so big. Here's another thing I found that I thought was kind of interesting, although it's not totally relevant, but it's pretty interesting. They spun off from ConAgra in 2016, so they've been, I guess, on their own. So this is 2024 for about 8 years now, 7 years plus. And since their spinoff, October 6th, or as of October 6th, 2023, so this was in their investor materials from their investor day last year, they had a return of 221% versus the S&P of 126 versus the food and beverage of 62. So, over that, I guess since it's a year ago, well, that's about 6 months ago, it's about 7 years. So over that 7-year period, they performed very well compared to the S&P. So I thought that was a tangent point, but it's not necessarily totally relevant for where they're at right now. So solid products and fries are popular, and the attachment rates. Now, attachment rate means that, if you go to McDonald's and you order a Big Mac, if you get like a meal with that, then you're attaching fries and a drink. And so the attachment rates remain high, as fries are one of the most profitable attachment items. I thought it would have been drinks, but it actually turns out that it is the fries. So let's go ahead and talk about some more things. I'm going to talk about, a myriad of things, positive and negative, and we're going to come to the end, and I'm going to tell you why I decided to, end up investing in them. So they're not vertically integrated. They basically are the potato producer. So they don't grow the potato. They contract with farmers. Farmers then deliver that product, the potato, to Weston facilities, and they process it and deliver it out to their customers. So they're not vertically integrated, but they do have contracts with the farmers that mitigate risk. They had, this is why their stock dropped so much here recently. They had a disastrous ERP, enterprise resource planning system rollout that led to a drop in customer fulfillment rates, first of all, lost market share, number 2, and inventory write-offs, number 3. So they had a really tough quarter when it comes to an implementation of their ERP system. So that's not very good. We'll talk about that a little bit more here in a bit. There is, believe it or not, sluggish QSR demand. What is QSR? QSR is quick service restaurants, McDonald's, Burger King, Wendy's. So there's some sluggish demand there. And back when they had their call, they really sounded the alarm on that, because investors weren't ready for, McDonald's and those guys to say, hey, our demand is slowing down. Inflation is really hitting our business. So, the QSR environment is going to have to do something to kind of build that volume back up. North America's there, we talked about that. They're the largest producer in North America, second to McCain and globally. And then management believes it will take time to recover the market share, but they expect to get there. So they are recognizing and owning the issues that they had, and they realize that they're real, but they are going after that, and they're going to try to recover it. So they have tailwinds, though. These tailwinds means that, it's going to push them forward. And this was interesting to me. Only 23% of U.S. restaurants offer fries. So think about the other, what would that be, 77% of the restaurants. If any of those, added French fries to their menus, then, there's some growth potential. They also have a popular product across all age groups. Everybody loves French fries, yo included. Fries are a profitable addition for restaurants at an 81% margin. So what that means is that Weston is not trying to convince Burger King, McDonald's, Wendy's to have fries in their value meals. They're not trying to convince them of that. Those quick service restaurants are looking at 81% margin, and they're saying, we want fries as a part of that meal. So I call it, it's not really a push, right? The Weston is not trying to push fries on them. The QSR restaurants are trying to pull fries into the mix. So I think that's an important thing. And innovation, which are like coatings and shapes. There's not really a lot you can do with potatoes, but coatings and shapes. And then new products like these Domino's tots. I think, they've been advertising those. Evidently, Starbucks is getting into some potato kind of stuff for their breakfast as well. So, they're trying to expand their market. I don't know how big that's going to be, but there is there are some tailwinds related to that. Geographic cost advantages. Their plants are located close to the growers. If you've ever grabbed a bag of potatoes, they're very heavy. The heavier they are, then the fewer they can be on a truck. So as you haul these things, you want them to be, as close as possible to the growers to cut down on freight costs. Uh, and then, here's the negative side. They lack pricing power. These QSRs, Wendy's, Burger King, McDonald's, they can get fries wherever they want. So companies like Lamb Weston don't have the ability to say, hey, I'm going to charge whatever I want for my potatoes, right? It's very competitive. So, back in grad school, one of the things we learned is that a company can either focus on, being differentiated by the products that they serve or that they offer, and bells and whistles, quality, those kinds of things, high margin. So they can either focus on that side of the equation, or they can focus on being the lowest cost producer. I think Lamb Weston is set up to be one of the lower cost producers. So I think that they have a bit of a competitive advantage because of their geographical location and things like that. So I think all of that's kind of working together to bring them a bit of a moat, if you will. Just some other things, some takeaways. Their largest risk is commodity risk. What happens if there's a potato shortage? What happens if it doesn't rain, right? So I think there's a risk in the commodity itself. Lamb Weston has capabilities, geography, and high margin pull through. That's that pull through I was talking about. That gives it a narrow moat, and at least in my opinion, Lamb Weston does not have iconic brands. They do not own the Idaho potato. That you as a retail person wouldn't necessarily recognize the Lamb Weston brand. So that's something to keep in mind. Management stumbled in the release of its new SAP ERP implementation. And I want to talk a little bit about that. I've been involved in at least one of those, maybe more. Maybe I'm blocking it from my memory, but that's a big deal. I mean, when you take a company's brain and nervous system and you replace it with something different, it's tough. It's a hard thing to do, and they said that they did a lot of work, and I certainly believe that, but they didn't do very well in that transition, and because of that, they lost market share. They had to write off some inventory, and their metrics stumbled a lot with their customers. So they've got some problems, but I seem to remember another company who struggled in that category. Do you guys remember who that was? So if you can remember which company was shut down for a period of time because of their transition from their old legacy ERP system to the SAP ERP system, let me know in the comments below. It's a vague memory. It's not recent. It's probably 15 years ago, but it is important to understand that and it's a big company. It's actually a company that I own today. So that maybe kind of narrows it down a little bit for you. So, but I'm going to let you guys try to answer that, and then I'm going to come back to it. Their strategy is focused on lower costs. We talked about that. And their debt levels are high, but they have no significant refinancings in the next 3 years. So I think from a liquidity perspective, I think they're going to be just fine. So there's our takeaways. I'm going to go ahead and tell you what I'm doing, and then I want to see what kind of guesses you guys have for the companies the company, the one company I'm thinking of that had an abysmal implementation of its SAP or ERP system. So what am I going to do? The moves for the Wealth Circuit investing portfolio is I started a position in Lamb Weston today, approximately 1% of the portfolio. It's probably a hair above that. And used to, I would start with 50 shares or 100 shares and then, kind of work it in. But then what happened is I ended up with a bunch of companies that I only had 50 shares or 100 shares in. So about a year or so ago, I committed to myself that if I didn't feel strong enough to to put at least 1% of the portfolio in it, it wasn't worth investing in. So 1% of the portfolio. I'm going to keep an eye on next quarter's earnings to see if they've made significant progress in the ERP implementation and they're recovering their lost demand. So one of two things can happen here. I guess there's probably anything in this range, right? So they could come back in the next quarter and they can say, hey, you know what? We still got troubles with our ERP system. We're still struggling getting orders out. We've got to write off some more inventory. That's one scenario. The other scenario is, hey, we got this figured out. We burned the midnight oil. We got, all of our systems are up and running. They're a go, and we've recaptured the lost business that we had. That's the other side of the equation, and it could probably be anywhere in between there. I'm looking for them to actually work through these issues. It's going to be a lot of manual work, so it's going to be somewhat inefficient, but sometimes you got to be inefficient to get things to work. So I believe that's what we're going to see. But who knows? And I'm not in this for a quarter. This is not going to be a short-term investment for me. I'm looking at this for the long term. The other question for the long term is, will Lamb Weston's new modern ERP system actually improve its ability to get its product out, to manage its working capital, to manage its orders, to manage its metrics? If it can figure that out and it can take the old system and replace it with this new one and have it hum, then I think there's some value in the efficiency that's going to improve their cost structure over time. So there's a couple of things that we'll chat about, but I ended up buying, I think it was 200 shares or so, somewhere in there. And it closed maybe a dime below where I bought. So, I bought, pretty much at the low for the day. I think I was a dime off. But we'll see. And if it drops a lot, then, it is what it is. So I'm going to go back to the question of this ERP system. So let's see what kind of guesses we have here. Pat says Kraft, and that's a good guess, but it is not the right one. Jim Betts asks if it's Budweiser, and Pat asks again if it's Conagra. But we do have a winner, and it is Shaping, who is now Rust Moments. So I'm not sure what that means, but I wasn't sure what Shaping meant either. But so that's good, buddy. You got it. Hershey had big issues with its ERP implementation way back 10, 15 years ago. So I think Lamb Weston is in good company there. Let's take a look really quick at some of their metrics, and then I want to find out what you guys are buying. Let's do this. Let's share a different window here. Let's share screen. I'm going to go to, let's go to the window, the special window. We'll go to this right here. All right, here we go. It was Hershey, so I'm going to take that off. Let's go to Simply Safe Dividends. That's always a fun one because they have a lot of stuff just like on one screen. Let's take a real quick look. LW is the ticker symbol for lamb, Weston. It's really interesting. I don't know why they have lamb, because they don't serve any meat. It's only potatoes. So, all right. So a low dividend yield. So if you're looking for higher dividend yields, then this is not the company for you. 67. So a safe dividend, but not very safe, as some of my companies have. You'll see that they actually grew the dividend by 29% back in 2023, so about 6 months ago. So that's a good sign. Let's go down here. Their 5-year dividend CAGR is 7%. You can see that they spun off in 2016, so their first dividend was actually in 17. So you see that has grown pretty consistently over that time frame. And let's see what else we got here. Let's look at some of these metrics. So look at the earnings payout ratio. Drops dramatically in 23, down to 23%, 22%. And, it's around 24%. They are struggling, though, from a cash flow perspective. And at least what I've gotten comfortable with is that these are investments in their processes, in their factories, in their equipment. And then they're also purchasing some of the joint ventures that they have overseas. And some of that is showing up in this free cash flow, which is driving it negative. So it's not that the business is not performing, it's that they are spending money as well. So I would rather them not be spending the money, but I would rather them have the long-term focus and spend the money on the plants. Let's see, what else do we have here? Earnings per share. Look at this earnings. Just, it was flat, and then all of a sudden it just takes off. So that's what we like to see. And let's see, shares. They haven't done much with their shares outstanding. Sales are going through the roof. And I think the ERP system, see, the deal is that back when they were doing all of this, look at the sales. They've been pretty consistent, growing slightly. All of a sudden, they jumped dramatically, like 25%, and then another 20% on top of that. So their volume has grown so much that this ERP system is essential to their future. So they've got to do something here to relieve the internal mechanisms. So I think it's essential that they get this done. Let's look at return on invested capital. It's around 16 to 19, 18%, somewhere in there. I think that is that's fine. It's not, it's not blowing the doors off, but with maybe a cost capital around 7%. That's not so bad, 7 or 8%. So they definitely have a positive return on invested capital. Their net debt is a bit high. It's around 69% of their total capital. So, that's something to keep an eye on. But like I said, they don't have any major restructurings coming along in the next few months, or in the next few years. And then their interest coverage is pretty much right on that 8, which is what we like to see. We like to see it higher than that. But they do have, so one thing to point out, they do have a lot of debt. And that's one of the things we want to keep an eye on. So, wow. I think that's it. I mean, there's probably other stuff we could go through, but you guys are probably tired of hearing about this. I want to put it on your radar screen. Maybe it's something for you to look at. I wanted to walk through my thought process. I believe that they do have a competitive advantage in that they have a low cost process. They've got, they're near the growers, and so they've got this process in place. Plus, the high margin is a pull through rather than a push through. So I think all of that leads to at least a narrow moat for them. And, I think the stock price took a big hit because of a short-term issue. And sometimes when we have short-term issues, it can lead to long-term value. I think it's a value stock at the moment, and that's why I invested in it. So there we go. So yes, let me go backwards here and catch up with what you guys are saying. Let's see. Okay, here we go. We've got Oscar. Oscar's in the house. I'm going to go ahead and get rid of this. So, Oscar, hey, it is great that you are on live. I am so glad you're here. We got 23 on the broadcast right now. So, man, this is really good. I think we were up to 24. And then, I started rambling on about stuff that nobody really cares about. And then we dropped back to 20. So, anyway, it's all good, my friends. So, Russ, today he bought 2 Visa and 2 ADC. I think that's, is that Agree Realty? I'll look it up real quick just so I don't tell you wrong. Yeah, Agree Realty. So that's good stuff, my friend. So yeah, Jim, you're right. French fries. So John J., have you heard of Ray Dalio's all-weather portfolio, and what are your thoughts on that one? That sounds familiar to me, John, but I can't pull up in just off the top of my head what that is. I will tell you this, though. I have finished reading a book called Margin of Safety. It's summarized by a guy that I will forget his name, Paul something, and it was written actually by somebody else, Seth Klarman or somebody like that. So, but it was a great read. And it also kind of helped me put things in perspective. So I'm putting together some slides on that. I can't wait to put some videos out on that. I think it's going to be helpful. It was helpful for me, so hopefully it's helpful for you guys as well. So, Russ, do they make lamb fries? I don't think so. But I just don't know, my friend. Maybe they do. If they do, maybe we can order some and fry them up. All right. Oh, Greg is here. He's rewinding to start at 2x speed. So that's going to be a lot of Southern accent going really fast, man. All right. Gabby Bear is on. It's good to see you. I am right in the middle of Lamb Weston country. So that means you are probably up in the Northwest. So never thought about investing in them. Yeah. It's not for everybody, but I wanted to share stuff with you guys tonight. If it kind of whets your appetite, take a look at it. See if it works for your portfolio. Providing fries to McDonald's, Burger King, and Wendy's sounds like a sound business model to me. The company that provides raw sushi, not so much. Yeah, I'm with you on that. The only sushi I will eat is anything that's cooked. I really don't eat raw sushi. I will eat, California roll. I'll eat shrimp tempura. It's got to be cooked though for me to eat it. So I don't know. Maybe that's a Southern thing. Seeking Alpha has a warning on Lamb Weston. Does that bother you? And yes, I at least I think I understand what the warning is. The warning is about their performance and about this SAP ERP system. So that warning has not that one specifically, but there's a lot of investors are shying away from it because they're not really sure how they're going to deal with this ERP system. Having lived through SAP, understanding the system and how it works, I think they're going to get there. It's going to take a little while, but I think they're going to get there, and I think it's going to actually help them in the future. So that's the way I'm looking at it, Pat. Sometimes, we just gotta step out there and do something that other people aren't willing to do. I could be wrong. It could tank, but I really don't think so. I mean, I think they're gonna turn this ship around. So I think we're definitely gonna see the value come back. I think we're probably gonna see 10 to 15% increase in share price over the next year, maybe even 20%, depending on how well they get back on track and how quickly they're able to do that. And don't forget, they lost some business, so how quickly they're able to recapture that business. If they can really knock that out of the park, then the investor community, I think, will come back to them. And if not, it'll take a little bit longer. So TipRank shows it as a strong buy, and I think that's what I'm seeing as well, Jim. I didn't look. To be honest, I didn't look at tip ranks, but they're showing it as a strong buy, so that's good. They have an average price target of $109. That's a pretty big percentage of upside. So let me do this. Let me pull up for you guys. We will pull up tip ranks and LW. We'll see what the analysts have to say. Analyst forecast is that they're currently trading, as you see here on the left-hand side of the screen, they're currently trading about 87.35. I think I bought it at 87.45. The average for the top analysts, I like the top analysts because they're a little bit more, I guess, more stringent. So you see the average price for top analysts is 105. The average price for all analysts is 109. I typically will go with the top analysts just to, those are the people that perform well. Those are the people that kind of have a good process in place. So they're saying, $105, which is a 20.5% upside potential. That's kind of what I'm seeing as well. So I'm excited about that. I think we're going to see that value come back. So to me, this is a value investment. It is not an income investment. Obviously, with the low interest rate or dividend yield, it is not a dividend growth investment. Even though I think we're going to see dividend growth over the long term, I'm not buying it for that purpose. I'm buying it because I think the stock price has been overly penalized for a short-term issue. I think the over the long term, this issue will be resolved and they will be able to recover this business. So to me, this is a value investment. So there, that's all I got. All right, let's go back to here. So yeah, that's I think in there is a 25%. So he says, John Jay, I can see McDonald's giving you French fries for like $200. They may sell less altogether, but for home company can still do good. Yeah, I'm not really sure. French fries for $200, man. That's a lot of money for French fries. It'd have to be a big group, buddy. All right, John, you got a couple more here. It was a few years ago. I was in McDonald's and asked for a large fry, and I was shocked how expensive it was. Yeah, no, that's right. If you order fries just separately, they realize that people love French fries. And so sometimes people just want French fries. I know at Wendy's years ago, I haven't done this in forever, may have been during college. There was a fad or a rage where people would go to Wendy's, they would buy a Frosty. This is really healthy, by the way. If you're health conscious, you're going to want to follow this. They would buy a Frosty and French fries. They would dip the French fries in the Frosty and eat the French fries with the Frosty on it. So, that's healthy right there. So, but yeah, so they got it figured out, man. If you want French fries, best way to do it is get a value meal because they will charge you a lot for French fries. Let's see what we got here. Slammer says he was looking at Lamb Weston last week and just seeing that red alert thing on Seeking Alpha pushed me away. Yeah, I get it. It's a it's if I could say unequivocally that they are gonna like blow the doors off this thing, I would, kind of like Air Products. I was really kind of really forceful or forward about Air Products back when it was $219 a share. I was like, guys, we've got to get in on Air Products. This is a value play. I think Air Products today is somewhere in the 270 range. So, I think we did well there. This is not an Air Products situation. It's probably more like an ADM, Archer Daniels Midland situation. So that's kind of what I'm looking at on this one. And that's why I'm not jumping in with both feet as well. I don't have 5% of the portfolio in this. It's only 1% of the portfolio. Let's see. Russ has got some numbers here: 18.8 and 15.7% ROCE and ROIC. So I think those are pretty decent numbers. Again, they're not Microsoft numbers, but they are pretty decent numbers when it comes to food supply. Let's see. Jim Betts, Southern Company with no, it can't be Southern Company. Oh, so that's not Southern Company. SO is Southern Company, but that's not what Jim meant. He said, so with 81% margins, am I correct that for a $1 bag of fries, 19% is the actual cost of the French fries and 81% is profit for the restaurant? I think that is exactly right, Jim. That's the way I'm interpreting this. So, yeah, I think that's right. It's a really high margin for the restaurant. The restaurant, so you can see what I'm saying, right? The restaurant is not saying, hey, because you couldn't deliver these French fries, we're just not going to use them anymore. No, they're like, there's 81% margin here. We are not going to do without our French fries, right? So there's a pull through strategy here where the restaurants are saying, we are going to serve fries, and it can be with you or somebody else, but we want these fries. So so it's a high margin product. Absolutely. Except it doesn't have a very big moat, right? Yeah, no, I think that's right, John. It is not a wide moat. I think it might be a narrow moat. And I think the moat really is focused on their ability to be close geographically to their growers because of the weight of the product. So they have plants that do the processing all in that area. And so they have that geographic presence. Plus, you have this pull through high margin strategy on the other side. So you've got a low cost model pulling a high margin product. I don't think Lamb Weston gets a ton of that margin. I think most of that goes to the restaurants, but it's still, in my opinion, a narrow moat. So that's the way I look at it. Management effectiveness, total return on assets. Okay, yeah, we just got some numbers there. Let's see. John J. Farmers like the contracts because oftentimes get an advance to help with planting, etc. Welch's Grapes had the same type of business model. Yeah, I think that's right. And that's pretty common. I know that when I was in the poultry business, believe it or not, even before I raised chickens, I used to work for Cargill, which is at the time was the world's largest privately held company. And we had contracts with growers. They would grow our turkeys and chickens and things like that. And so that's a really good model for not only the business, but also the farmer. So at least in my opinion, it was. You'd probably find other people that would disagree with that. So Jim Betts John J wants Jim to fix him up with the farmer's daughter. Oh my goodness. I think we've gone off the rails here, guys. Be careful with that shiv you made, the pencil you sharpened. All right, let's move on here. I'm gonna skip through some of these because those were the guesses on the ERP system. Yeah, I'm with you, Jim. I'm not really sure where to go with that. Jim says he's stumped on a witty comeback for the farmer's daughter comment. So Rust Moments won. You won the prize of being recognized for winning. So that's good. All right, let's see. Jim Betts. Let's see what Jim bought. Jim bought some Raytheon RTX. He bought 3 of those. He bought some General Dynamics, Lockheed Martin, Lyondell. I think that's Lyondell base, and Johnson & Johnson this week. Those are some solid pickups, my friend. You got some defense going on there because, of course, General Dynamics and Lockheed Martin are 100% defense, and Raytheon is probably 50-60% defense, and then they got commercial operations as well. But then Johnson & Johnson, we all know who they are. So that's pretty solid, man. Good stuff. He's thinking about selling a small portion of the portfolio of Stanley Black & Decker. Thoughts? Man, I tell you, let me, if you got a minute, I'll talk a little bit about that because I'm thinking the same thing. I have way too much of my portfolio in Stanley Black & Decker. It has been an investment that did not work out for me. I've had two of those in the last few years, and it is Stanley Black & Decker and Whirlpool. I have sold off some of the Whirlpool back when it was around 120. I didn't sell it all, but I think I'm looking at maybe getting rid of half of my Stanley Black & Decker. And to be honest, where I'm kind of at with that is, there's this thing that's in the back of my mind, and I know it's a bias. I know it's there, but I can't ignore it. And that is, as soon as I sell it, it's going to go back up. Right? And every time I kind of go through the process and say, I'm going to sell it, no, I'm going to hold on to it for a little bit longer, it keeps going down. So I'm thinking that I'm just going to bite the bullet, sell half of it, and get it to be such a small part of the portfolio that it doesn't drive a lot. And, and we'll kind of go from there. I think it's a good, they have incredible brands. And I think that management is doing what it can. I just don't think that there is enough, of a economic drive for those products at this point. So I think we're going to even see it decline further, with all the interest rate increases and, things like that. So Jim, I'm kind of in the same boat with you. I'm thinking I may unload a few Stanley Black & Decker shares. I'm not sure when that will be. I don't know. It'll be one of those things where one day I'm just kind of looking at it and I'm, for the last time, I will just bite the bullet and do it. It'll probably be soon. It won't be tomorrow, but it'll probably be soon. Slammer 6789. He bought some CRM. So yeah, that's Salesforce, I think, right? Maybe not. Let me look that up real quick. CRM. Yeah, Salesforce. So that's Salesforce. They've had a tough week, man. Let me pull them up here. We'll look at them in tip ranks. Let's look at the stock analysis, and we will go to the 5-day look. Make it a 3-month look. You can see that maybe it's a little longer than maybe it was last week sometime. You can see the huge drop that they had. I mean, it just plummeted. They have recovered a bit, but not nearly as much as when they got slammed. So that's good, Slammer. That was kind of an accidental thing. They got slammed, and then Slammer bought them. So it's good if you bought them after the earnings dip. I think you're going to do okay. It's just a company that I looked at them probably 3 or 4 or 5 months ago, and it wasn't. They just didn't have enough, competitive advantage for me. However, at this price, it might be a different story, right? If I were to look at them again now, it might be different. But right now, I'm not a Salesforce fan. So I hope that goes well for you. It looks like it has. I mean, look at this. Let me get back to this right here. Looks like, if you bought it down in here, looks like you're doing pretty well, my friend. And so that is fantastic. And that goes, here's an old adage that I will tell you, and that every stock is worth something. Unless it's bankrupt, every stock is worth something. So, so there you go. All right. Seth Klarman, that's who it is. The summary of margin of safety. And it's the guy that did the summary is Paul Martin, maybe. But yeah, I tell you what, if you don't want to listen to it or read it, then just wait for these videos, because I've been putting together some slides, and it's been really powerful to kind of see all of this come together. Russ says, I'd like to air fry sweet potatoes, make my own fries. That's a great idea. I love sweet potato fries, But I'll tell you what, when we lived in Ohio, you probably noticed that I have an accent that is, let me go ahead and get rid of that, that is a little bit confused because I lived for over 20 years in Ohio, was born and raised in the South and back in the South now. So I have, this old Southern accent mixed with the Midwestern Ohio accent, now coming back with a bit of Southern accent. So it is just really confused. But anyway, air fried sweet potatoes. When I lived in Ohio, there was a restaurant in Hudson, Ohio. It was called the Flip Side. It's Flip Side Burgers, and all they did were burgers, but they had some incredible sweet potato fries there. But they made their own horseradish sauce. So not ketchup, not barbecue sauce. It was a horseradish sauce. It wasn't just horseradish, but it was a horseradish sauce. And with sweet potato fries and that horseradish sauce, to die for. So if you get a chance, go to your grocery store, find some horseradish sauce. There's a couple of brands out there. Keep going until you find the one you like. But if you have sweet potato fries with horseradish sauce, that's worth being on the live stream tonight, my friend. That will pay dividends for many years to come. You must not have seen, this is my buddy Russ, you must not have seen Funny Farm with Chevy Chase. No, I did not. Lamb fries are lamb testicles that are prepared as food. I understand now. I see what you mean about the lamb fries. So, we called those, of course, it was more of a cow, I guess, but we called those Rocky Mountain oysters where I grew up. But lamb fries, that works too. All right. What else are you guys buying? I want to hear what you guys are buying. We talked about Jim's purchases. I'll talk about mine here in a second. Kevin Rayberg. Now we do have count them, 4 Kevins in the broadcast tonight. We are definitely at a quorum. We can probably solve world hunger with 4 Kevins in the program. So he's slips in quietly, mumbling something about better late than not showing at all. That is true, my friend. All right, let's see. I'm going to go through John's here. And do you have any hedging strategy for your portfolio, such as hedge fund uses to reduce downside and increase upside? That's a great question. I don't use hedge funds at all because I don't know enough to know which way the market's going to go. So anytime I hedge, I'm actually paying for insurance. So let's say I use options to hedge my portfolio, or even stop losses for that matter, because sometimes a stock can drop and then come back, right? I mean, we see that in CRM. We see it. We saw it in what was the stock? Berkshire Hathaway today. I think it went from $600,000 down to $189. But who knows what that was about? I don't know. But so anyway, the stock can drop and then come back. So you end up selling out, and then you're not able to buy it back at the same price. So even stop losses have a bit of a insurance cost to them. And so I tend to not want to give that cost away. I'm more willing to kind of ride the valleys, and I'm a long-term investor. So I like to buy. I'm not a buy and hold forever investor. I'm a buy because I have an investment thesis. And if that investment thesis goes away, then I'm a, sell and move on to something different. So I'm a buy and hold until I find a better use for the money investor. Maybe that's a good way to put it. So, I don't do a lot of hedging, and I don't have a hedge. I don't use a hedge fund at all. So maybe I should. I don't know, but I just don't. So Rust has been buying, not Rust, but Rust has been buying CRM, Salesforce. They make more free cash flow than Coke. That's good. That's good to hear. Okay, Oscar, he is buying Visa, Snap-on. Oh, good. You bought into the Hess Midstream. And McDonald's, I'm not sure. PAGP, I'm going to look that up real quick. PAGP. Plains GP, that's a general partnership holdings. So let me see a little bit. PAGP, Plains General Partnership Holdings. And they here, I'll show you guys what I'm looking at. I'm curious because I've not heard of them, so I just wanted to kind of get. They are energy, oil, and gas storage and transportation. And let's see, they've got a 50, a borderline safety, dividend safety rating. They got a decent payout ratio, 47%. But what I really wanted to look at, oh, wow. Let me, I'll come back to that. But, well, I got so enamored with it that I kind of lost. Oh, I wanted to see, okay, they are a qualified dividend. So I was thinking they would be unqualified, but they are qualified. They do issue a 1099. So that is good. So who was that? Oscar. Oscar, tell me about this dividend. You see that the dividend went to 250 down and up and down, and it's on its way back up again. Is that just basically cyclical, related to some of the, I don't know, some of the flows that they have, or I would be a little concerned with that. And let me just show you why. When I look at HESM, so this started about 2012. Hess Midstream, which is a 40, I get that. But look at the dividend chart on it. It is up and to the right. That's what I love to see. So I don't know. Let me know, Oscar, what you think about that. I've never seen PAGP before, so I thought I would just throw that out. You didn't ask, but it's my show, so I get to give my opinion. Let's see. John J. Sales down 13, down for PAGP. How about KMI? Yeah, KMI, Kinder Morgan is another pipeline company. Kinder Morgan is a national firm. I used to own them several years ago. Our buddy, Mr. Income, has some issues with their CEO. I was not an investor at that time. And but anyway, I think Kinder Morgan is fine, but they tend to kind of be stuck. They're kind of stuck in a range. So anyway, UNH. So Greg has bought UNH, United Healthcare, and COR. So for some reason that's not pulling up. Cencora, I don't know who that is. They're a healthcare distributor. 88 safety rating, 8 point. Wow, look at that, 0.88% dividend yield and an 88 safety rating. So that they're just a company of eights, and so yeah, it looks pretty decent. Looks like a good company. So yeah, I'm not familiar with them, so that's a good. Their numbers look fine, so that's good to hear. So what have I bought? I have bought, as you know, I bought Lamb Weston today. I have been buying Johnson & Johnson, which there we go. Maybe that'll work. Enter. Wonder why that's not pulling up. Let's try this. There we go. We got it now. Yeah, Johnson & Johnson is just killer. Johnson & Johnson, 98, 99 dividend safety, AAA credit rating. They've got this overhang with this lawsuit. I think we're probably going to see that resolved in the next 6 to 12 months. I am a Johnson & Johnson fan, and they are actually, I think, my number 2 holding. Air Products is number 1. It really didn't work out. I didn't make it that way, but I ended up buying so much when it was low. Now that it has moved up in the 270 range, it has surpassed both Microsoft and Johnson & Johnson. to take the number one spot. So Johnson & Johnson's number 2, I think, and Microsoft is number 3. So I've been buying Johnson & Johnson and Lamb Weston, and then today I also bought Hess Midstream. Hess Midstream is a midstream company. It's in the Bakken region, up in like the North Dakota, South Dakota, Minnesota area. And but the reason that it's a 40, in my opinion, considered unsafe by Simply Safe Dividends, it's because they're basically dedicated to one customer, that is Hess Petroleum. So Hess Petroleum is currently being bought by Chevron. But in my opinion, the contracts that are set up for Hess Midstream with Hess, which will then be moved on to CVX or Chevron when that's done, I think that's going to protect Hess Midstream. Those contracts guarantee not only the flow, but also the price for a 3-year period. So I think for a 3-year period, we are in good shape with Hess Midstream. So I bought some more of that. I have like 950 shares now. Yeah, see that? 950 shares. And my average cost is 27. It's been trading around 34, and it is down right now. I think it's been around 35, 36. So I've been very happy, and I've had Hess Midstream for several years now. And then the other one that I have been buying, if you're interested, is U.S. Bancorp. They're at 55. Why am I buying U.S. Bancorp? Well, let me show you. We're almost out of time, but I will pull this up. Let me pull up U.S. Bancorp, and you can see that they've got a fair value from Morningstar at $53. They were below $40 today, so they this says their price was $40.55. But I think let's take a look at tip ranks and see what they closed at. USB, they closed around $39.73. So they're at a 23% discount according to Morningstar. It's probably more like 25% now that they're below $40 a share. I think U.S. Bank, it's got a high dividend, which is like 5% or so. So it's one of the income stocks that I believe also is a value stock. So I'm looking at it as a kind of a double dip. I'm getting 2 things for the price of 1. So I'm continuing to buy that. I don't remember how many shares I have of it. I can look right here. I have 900 shares of U.S. Bancorp. So kind of rounding out my income portfolio, it is pretty much fully invested. When I talk about my income portfolio, it is the portfolio that is an after-tax account. I can get to those dividends whenever I need them. I can even get to the principal, and I've needed to do that over the past few months. Just anytime that I need to. It's not in my 401k. It's not in my Roth or anything like that. So my income portfolio, I can get to these investments like U.S. Bancorp, like Hess Midstream. Let me think of some others. Prudential, IBM. Those higher dividend rates are in my income account. So I really like to have that income there because it helps, since I'm retired, it helps me to kind of live from day to day. So there's that. All right. Well, there we go, guys. I think I don't see anything else of. Oh yeah, so Rust has reminded us about the Discord. I'd love to see you in there. We, if you're wanting to chat or ask opinions or whatever, that's a great place to do that. I'm in there pretty much every day. I don't usually. I don't respond to everything, but I'm reading everything that goes on in there. So yeah, there's that. And let's see, what else do we have? I don't think that there's anything big going on this week in the economy. We had PCE, I think it was last week. So I don't think there's anything wild going on. So, and Slammer says, hit that like button. So now that would be awesome. I really enjoy getting together with you guys. This is really kind of fun. And I like it when we kind of, throw things around a bit, especially with talking about what we're buying. So I do have plans for some videos. I was going to do them last week and just was sick as a dog. So this week I do have plans for videos. I'm not going to tell you what they are because I think it's going to be really catchy. So you want to keep your eye out for those. And with that, I think we are going to say we're going to sign off for tonight. And again, I have had issues with my closing song because it is copyrighted. So I got to figure out, something for that. But maybe you guys have some good ideas for me. But with that, I'm going to let you guys go. Have a great rest of your night, and I will talk to you on the next one. See you guys.